Trading setups and the entry, it seems to be the most sought after trading information, and for good reason. Because without a trading setup, you're going to be trading blind and without an entry, well, there's no position. The issue is that while traders know how to enter a trade, finding a profit target and a break-even point, or just simply a place to limit your risk, it seems to be forgotten, but they're needed for any trading strategy. Let me say that there's never a best place for trade management. There will be times that you limit risk by moving your stop and then it gets hit while the trade is still valid. You will exit your trades for profits only to see the price continue in your favor. And if you approach your trading as a risk manager first, that can alleviate some of the frustrations that you're going to get when those things do happen. You did your job, you protected your account, and you're going to live to trade another day. Now we know that markets make higher highs and higher lows when they're moving up and the opposite when they're heading down. A higher high can only be made when price is pulling back, and depending on your trading method, this presents both long and short opportunities. So looking at this chart here, we can see that price is in an overall uptrend. It's clearly an uptrending pattern with prices making higher highs and higher lows. Now traders generally want to be long in these markets, but they also love to catch turning points. I think there are too many contrarian traders who are just looking to pick tops and bottoms as routine. Now here, number one, price puts a top in and does not appear to be a climax move, which in my playbook, it's important for a counter trend trade. And number two, we still have a higher low, so the uptrend's still in play. And number three, failure to make a new high and momentum against the upside is cause for concern. Now some traders will use that failure to make new highs and momentum against the trend as a setup for a short below point number two. That's not a bad play because what price pattern does in a downtrend? Well, it puts in lower highs and lower lows. Breaking the highest low at number two puts in a lower low. So we do have both conditions in play on this chart, but it's not that easy. A simple pullback is one leg, and then we get a continuation in the direction of the trend. In our chart, if price continued to rally past the highs, our trend continuation is a success on one swing on this time frame. Lower time frames could show a complete downtrend structure and then a resolution. So remember that time frames do play a part in our chart formations. It is entirely within reason that an intraday trader could be trading a downtrend bias because that is what their time frame is doing. Until our chart here has the pivot at number two taken out, we still consider an uptrend, or at worst, a range if price cannot break the high. So let's assume that you need to see price rejection to take a shot to the upside. Now, I don't just buy support, but I need to see some type of price rejection. But you should also notice that the previous pullbacks are one legs. Now, you understand the rule of alternation, and you expect to see a complex pullback. You can see the two legs in this price correction, and the green arrows highlight immediate price rejection. All things taken together, you place your trade above the high of the reversal candlestick, and you allow momentum to pull you into the trade. The big red candlesticks are showing momentum to the downside. And while we can never know for certain the intent of those traders, it is safe to consider that some are long traders that are selling their positions when the trend did not continue to the upside, and some are traders that are taking a trading position short when they did not see the trend continue. So you go back to the usual teachings, where do you think most traders who are short have placed their protective stop loss? Well, common wisdom is to place your stop loss in a position where you'd be wrong on the trade. The red zones are the usual spots for traders to place their stops, and you can make a case for both of these locations. Support and resistance zones appear to be a common location for traders, but you should determine what you consider a resistance level if you take a short position or a support level for long trades. So if we assume that this is where stops are located, we can also assume that some traders will also look to position short in those locations because they missed their first entries. Well, is that a good play? Well, if this is the beginning of a new trend, you'd prefer to not see price return to those levels too soon. And a few things can happen at these often volatile price zones. Price can be rejected again, and a new trend emerges as more sellers engage the market. Price can run straight through those locations, stop out the shorts, and propel the long traders quickly through the highs. price can just stall and consolidate. And while we don't know exactly what it will do, we do know that something is going to happen, and we can use that knowledge to our advantage. Now, we know something's going to happen at these zones, so it makes sense to use them as a point of reference for trade management. In the case of our chart, we have strong momentum into those levels, and we have nice gains in an open position. So the worst case for us is a complete meltdown on price that erases the gains of the last several days. By having a take profit or some type of trade management in those areas, we're using the structure of the markets in terms of previous turning points that offer potential resistance zones. The rhythm of the market as taking out the highs gives us the start of an uptrend pattern or a possible range. We're accepting that we just don't know what's going to happen with 100% certainty, and we're putting our risk manager hat on. Now, your trading plan should contain the actions that you're going to take at these zones. Will you scale a portion of those positions and leave partial for more gains? Will you take risk out of the market by adjusting your stop and play the overall uptrend direction? Will you be concerned about the momentum in the previous bear candlesticks and just exit your full position? You have to have a plan and consistently work that plan. But we don't know what, if anything, is going to happen when price meets those structured zones. Knowing what we understand about those types of levels, the probability is that something will happen. Now, if nothing does occur, having a plan in place such as scaling out at 1R, consider your risk-reward ratio, and going to break even that you use on every position does speak to consistency, which we can never overstate that. So think about it. If your position reaches at least to a multiple of the risk on the trade, is that not a success? So protect what you've earned. So after our complex correction completes with price rejection and eventual momentum, we ran into some issues that would affect how you manage this trade. At number one, scaling out a portion of your position around the price structure. Now, I use pending orders at these levels generally. That means you put some money into your trading account. And number two, what we would not want to see is momentum against our position. And we can see that right here. When you see strong moves against you, either tighten your stops dramatically or just get out. Using structure and unfolding price action allows you to take profits twice on this chart. Now, of course, there are going to be times where you enter and prices continues to fall and where price continues the trend. We never know when those times are going to occur, so it makes sense to either monitor price action on every single candlestick or set your targets and your pending orders to scale out risk out of the market. So as you can see, there's nothing guaranteed or perfect in trading. Understanding the context, structure, and trading psychology of the masses can be a huge plus in enabling you to add money to your account on a consistent basis. Some traders will use a moving average or Fibonacci extensions for price targets, thinking that there's an edge in doing so. Now, I've never been able to find objective stats nor produce any stats that show an edge to using those trading indicators in that way. That said, having some type of exit or trade management strategy is better than none at all, and those will provide you with some consistency. But more importantly, using those types of indicators will allow you to see a profit-taking zone of interest, and then you can determine a risk-reward scenario that will greenlight the trade or not. Now, using these types of levels for profit-taking can be a consistent way to add to your trading account because it does take into account so many other variables that other traders are looking at.